In March 1932, a body was discovered in a Paris apartment. The man was Ivar Kreuger, once called the Match King. He controlled two-thirds of the world's match production. His empire stretched across 6 continents and 40 countries. Banks, governments, and millions of investors trusted him completely. But the bullet in his chest told a different story. Within hours, his financial empire began to collapse. Stock markets around the world plunged into chaos. Investors lost fortunes they thought were secure. The crash wiped out billions in shareholder value. This is the story of history's greatest financial fraud, and the man who nearly broke the global economy. Ivar Kreuger was born in 1880 in Kalmar, Sweden. His father owned a small match factory. Young Ivar showed exceptional talent in mathematics and engineering. He studied at the Royal Institute of Technology in Stockholm. After graduation, he traveled to America seeking opportunity. In New York, he worked as a construction engineer. He helped build the Plaza Hotel and Macy's department store. Kreuger learned American business methods and financial practices. He saw how capital markets could fuel massive expansion. By 1907, he returned to Sweden with ambitious plans. His goal was simple: control the global match industry. Matches were essential to everyday life in the early 20th century. Every home, restaurant, and factory needed them daily. The industry was fragmented across thousands of small producers. Kreuger saw an opportunity for consolidation and monopoly. In 1913, Kreuger merged his father's company with competitors. He created Swedish Match, the foundation of his empire. His strategy was brilliant and ruthlessly efficient. He offered governments desperately needed loans during economic hardship. In return, he demanded match monopolies in those countries. Cash-strapped nations found the arrangement irresistible. Poland became his first major success in 1925. He loaned the government $75 million. Poland granted Swedish Match exclusive rights to manufacture matches. France followed with a similar deal worth $75 million. Germany, Greece, Turkey, and Yugoslavia all signed agreements. Even South American nations joined his growing network. By 1930, Kreuger controlled match production in 36 countries. His monopolies generated enormous profits with minimal competition. The Match King seemed to have discovered perpetual wealth. But Kreuger's empire rested on increasingly unstable foundations. He created a labyrinth of holding companies and subsidiaries. More than 400 corporations existed within his structure. Many existed only on paper, serving no real purpose. This complexity made independent auditing nearly impossible. Kreuger controlled the flow of information to investors. He published financial statements that looked impressive. Swedish Match reported consistent profits year after year. Dividends flowed regularly to grateful shareholders. Wall Street analysts praised his business acumen repeatedly. The New York Times called him a financial genius. President Hoover consulted him on economic policy matters. But behind the facade, Kreuger was running a Ponzi scheme. New investments paid returns to earlier investors. Actual profits couldn't support the promised dividend payments. Kreuger's methods of deception were sophisticated for their era. He forged Italian government bonds worth millions of dollars. These fake securities appeared on Swedish Match balance sheets. Auditors accepted them without proper verification. He manipulated currency exchange rates in financial reports. Profits in one country offset losses in another. He transferred assets between companies to hide shortfalls. Subsidiary companies bought shares in parent companies. This created an illusion of value and liquidity. Kreuger personally approved all financial statements and reports. His accountants followed his instructions without question. External auditors relied on documents Kreuger himself provided. The few skeptics who raised concerns were silenced quickly. Kreuger's reputation protected him from serious scrutiny. His empire grew too large for anyone to comprehend fully. American investors poured money into Kreuger's enterprises enthusiastically. Lee Higginson and Company, a prestigious Boston bank, promoted his securities. They earned substantial fees from underwriting his bonds. American holdings of Swedish Match securities exceeded $200 million. Pension funds, universities, and wealthy individuals invested heavily. The promised returns seemed conservative and reliable. Kreuger paid dividends of 6 to 8% annually. This appeared modest compared to speculative stock market gains. Conservative investors viewed his securities as safe investments. The Match King cultivated relationships with financial elites carefully. He dined with bankers, politicians, and industrialists regularly. His Paris apartment became a gathering place for power brokers. He lived modestly by billionaire standards, avoiding ostentatious displays. This reinforced his image as a prudent businessman. Few suspected the empire was built on fraud. The Great Depression changed everything for Kreuger's scheme. The 1929 stock market crash reduced available investment capital. Credit markets froze as banks failed across America. International trade collapsed, reducing match sales and profits. Governments that owed Kreuger money struggled with debt payments. His monopoly agreements generated less revenue than projected. To maintain dividend payments, Kreuger needed constant new capital. But investors were now cautious and suspicious. Banks demanded better documentation and independent audits. The Swedish government began investigating his business practices. Kreuger could no longer control the narrative completely. In 1931, his companies needed fresh capital desperately. He approached banks in New York and London repeatedly. They asked detailed questions about his financial position. Kreuger couldn't provide satisfactory answers without exposing fraud. By early 1932, Kreuger's situation became impossible. His companies owed hundreds of millions in short-term debt. Cash reserves had dwindled to almost nothing. He shuffled money between accounts to cover immediate obligations. Each transaction made the underlying problems worse. Swedish Match stock began declining on European exchanges. Rumors circulated about financial difficulties and accounting irregularities. Kreuger traveled frantically between Stockholm, Paris, and New York. He sought emergency loans to keep the empire afloat. Every bank refused without transparent financial disclosure. His longtime partner, Christer Littorin, demanded honest accounting. Kreuger knew the truth would destroy everything immediately. On March 12, 1932, he was found dead in Paris. A gunshot wound to the chest appeared self-inflicted. The official verdict was suicide, though some suspected murder. The aftermath of Kreuger's death was catastrophic and swift. Swedish authorities immediately began examining his company's books. What they discovered shocked the financial world completely. Assets listed on balance sheets didn't exist at all. The Italian bonds were expertly crafted forgeries. Profits had been fabricated for years through accounting tricks. The empire had been insolvent for at least 5 years. Total losses exceeded $500 million in 1932 currency. Adjusted for inflation, that's approximately $10 billion today. Swedish Match stock became worthless within days. Thousands of investors lost their life savings entirely. American shareholders filed lawsuits against Lee Higginson and Company. The prestigious bank's reputation was destroyed permanently. Several executives faced criminal charges for negligence. The scandal reached the highest levels of American finance. The Kreuger crash accelerated calls for financial reform. Congress was already investigating Wall Street practices aggressively. The Pecora Commission examined the causes of the Great Depression. Ferdinand Pecora, the commission's chief counsel, was relentless. He subpoenaed records from banks that promoted Kreuger's securities. The testimony revealed shocking conflicts of interest everywhere. Banks sold securities to clients while knowing about problems. Executives profited from fees while investors lost fortunes. Independent auditing was virtually non-existent in practice. Disclosure requirements were minimal and easily circumvented. The Kreuger case became a centerpiece of reform arguments. It demonstrated how fraud could spread across international markets and how prestigious institutions could enable massive deception. Public anger demanded accountability and systematic changes. Politicians recognized that financial system reform was essential. The Securities Act of 1933 emerged directly from these scandals. It required companies to register securities with federal authorities. Financial statements had to be audited by independent accountants. Material information had to be disclosed to potential investors. Corporate officers faced personal liability for fraudulent statements. Criminal penalties for securities fraud were substantially increased. The Securities Exchange Act of 1934 followed soon after. It created the Securities and Exchange Commission. The SEC was given broad powers to regulate markets. It could investigate suspicious transactions and business practices. The agency could bring civil and criminal charges against violators. These reforms transformed American financial regulation permanently. The Kreuger scandal had exposed fundamental system weaknesses. The new laws attempted to prevent similar frauds. But human nature and greed would continue testing these protections. Kreuger's personal motivations remain partially mysterious even today. He left no suicide note explaining his actions. Some historians believe he started with legitimate business ambitions. The fraud may have begun as temporary measures during difficulties. Success created pressure to maintain impossibly high returns. Each deception required larger deceptions to cover earlier ones. The Ponzi dynamic became inescapable over time. Others argue Kreuger was a sociopath from the beginning. He showed little emotion or empathy in personal relationships. His romantic life was calculated and manipulative consistently. He maintained multiple mistresses across different countries strategically. Each relationship served specific business or social purposes. Friends described him as charming but emotionally distant. He rarely discussed feelings or personal matters with anyone. His death eliminated the possibility of understanding his psychology completely. The Swedish government worked for years to untangle his empire. Liquidators discovered that some businesses were actually profitable. The underlying match companies had real value in operations. They were eventually restructured and sold to repay creditors. Investors recovered approximately 30 cents on the dollar. This was better than many expected given the fraud scale. But millions of dollars simply vanished without trace. Kreuger had spent lavishly on bribes and political influence. He maintained expensive residences in multiple countries simultaneously. His Paris apartment alone cost millions in today's currency. Some money likely disappeared into secret accounts permanently. Investigators suspected accomplices who were never identified publicly. The complexity of his corporate structure defeated complete accounting. Some questions about his financial empire remain unanswered today. The Kreuger case continues to fascinate financial historians. The scandal had international diplomatic consequences beyond finance. Governments that accepted Kreuger's loans faced embarrassment. Their monopoly agreements had been based on fraudulent promises. Some nations tried to void the contracts entirely. Others renegotiated terms after Swedish Match was restructured. The scandal damaged Sweden's international reputation significantly. Swedish banks and companies faced skepticism abroad for years. The government implemented stricter corporate oversight regulations domestically. Banking secrecy laws were tightened to prevent similar frauds. Accounting standards were reformed and professionalized substantially. The Kreuger case became required study in Swedish business schools. It served as a cautionary tale about unchecked corporate power and the dangers of financial complexity without transparency. European financial markets took years to recover confidence fully. The Match King's legacy was regulatory reform across continents. Comparisons to later financial scandals are inevitable and instructive. Bernie Madoff's Ponzi scheme echoed Kreuger's methods closely. Both relied on reputation to deflect scrutiny effectively. Both used complexity to confuse auditors and investigators. Both paid consistent returns to maintain investor confidence. The scale differed, but the psychological dynamics were identical. Enron's accounting fraud shared Kreuger's use of shell companies. Complex corporate structures hid losses and fabricated profits. Executives manipulated financial statements to meet market expectations. Auditors failed to detect obvious red flags repeatedly. The collapse wiped out employee pensions and shareholder value. The parallels demonstrate that fraud evolves, but doesn't fundamentally change. Each generation must learn similar lessons about trust and verification. Regulatory systems must adapt to new deception methods constantly. But human nature's susceptibility to greed remains constant. Kreuger's story also illuminates the dangers of financial concentration. His monopolies eliminated market competition across entire nations. Governments became dependent on his loans and influence. This created conflicts of interest that weakened oversight. Politicians hesitated to investigate someone funding government budgets. Banks promoted his securities because they profited from fees. They had no incentive to question his financial claims. Auditors relied on his documentation without independent verification. The system had too many people benefiting from the fraud continuing. Whistleblowers faced professional retaliation and social ostracism. Truth-tellers were dismissed as troublemakers or competitors. This dynamic appears repeatedly in major financial scandals. Concentration of power creates conditions for massive fraud. Distributed oversight and genuine independence are essential protections. The Kreuger case demonstrated these principles with terrible clarity. The Match King's fall also affected ordinary people profoundly. Factory workers at his match companies lost jobs suddenly. Communities built around match production faced economic devastation. Investors who trusted conservative securities lost retirement savings. University endowments that invested prudently suffered massive losses. The fraud destroyed faith in financial institutions among average citizens. Many concluded that the system was rigged against them. This sentiment contributed to political radicalism in the 1930s. Both communist and fascist movements gained support partly from financial scandals. The legitimacy of democratic capitalism was questioned seriously. Economic catastrophe and financial fraud created social instability. The Kreuger scandal was one element in this larger crisis. It demonstrated that even sophisticated investors couldn't protect themselves. The system's complexity favored insiders and fraudsters over honest participants. Rebuilding trust required more than just new regulations. Modern financial markets incorporate lessons from the Kreuger catastrophe. Independent auditing is now legally required and professionally standardized. The Big Four accounting firms emerged partly from these reforms. Securities regulations demand extensive disclosure of financial information. Corporate officers must personally certify the accuracy of statements. Penalties for securities fraud are severe and frequently enforced. The SEC actively monitors markets for suspicious activities. Whistleblower protections encourage reporting of fraudulent practices. International cooperation helps detect cross-border financial crimes. Yet despite these protections, major frauds still occur regularly. The fundamental challenge remains: complexity defeats oversight. When corporate structures become too complicated to understand fully, fraud flourishes. When investments promise returns that seem too good to be true, they usually are. The Kreuger principles still apply to modern investors. Verify claims independently, diversify holdings, and maintain healthy skepticism. The Match King's legacy extends beyond regulatory reform. He pioneered international corporate structures that became common. Multinational corporations learned from his organizational methods. His holding company model influenced legitimate business practices. Global expansion strategies borrowed from his playbook. Tax optimization through international structures followed his precedents. The distinction between innovation and fraud can be subtle. Kreuger's techniques weren't inherently criminal in themselves. The fraud lay in misrepresenting financial reality to investors. This raises ongoing questions about corporate disclosure requirements. How much complexity should be allowed in corporate structures? When does legitimate business strategy become deliberate obfuscation? These debates continue in boardrooms and regulatory agencies today. The line between sophisticated business and fraud remains contested territory. Kreuger's ghost haunts these discussions even 90 years later. Some historians view Kreuger with a degree of sympathy. He built genuine businesses that created real economic value. His match factories employed thousands of workers across continents. The monopolies he created did reduce inefficient competition. Some government loans he provided were repaid successfully. Without the fraud, he might be remembered as an industrial titan. His engineering skills and organizational abilities were genuinely impressive. The tragedy was that legitimate success wasn't enough for him. He needed to be seen as infallible and infinitely successful. This psychological need drove him to increasingly desperate deceptions. The lesson isn't that all ambitious businesspeople are fraudsters. It's that even talented entrepreneurs can succumb to ethical failures. Success creates pressure for continued success at any cost. When reputation becomes more important than reality, disaster follows. Kreuger could have been a legitimate business legend. The question of whether Kreuger's death was truly suicide persists. Some contemporaries suspected murder by business associates or governments. He knew secrets that could have damaged powerful people. His death conveniently prevented testimony about bribery and corruption. The evidence for suicide was strong, but not absolutely conclusive. The gun was found in his hand with his fingerprints. The apartment was locked from inside with no signs of struggle. But some details troubled investigators at the time. The angle of the bullet seemed awkward for self-infliction. Kreuger had shown no obvious signs of suicidal depression. He was still actively negotiating loans days before his death. These inconsistencies fueled conspiracy theories for decades. Most historians now accept the official suicide verdict. The accumulating pressure and impossible situation provided clear motivation. But absolute certainty will never be possible at this distance. The collapse of Kreuger's empire had long-lasting institutional effects. Lee Higginson and company never recovered from the scandal. The venerable bank closed its doors permanently in 1933. Partner firms that promoted his securities faced decades of litigation. Insurance companies that underwrote his bonds paid massive claims. The scandal accelerated the decline of private banking partnerships. Modern investment banks learned to limit personal liability carefully. Corporate forms replaced unlimited liability partnership structures. Risk management became a formal discipline in financial institutions. Due diligence processes were systematized and documented extensively. The industry's entire approach to client securities changed fundamentally. Kreuger's fraud demonstrated that reputation alone couldn't guarantee safety. Even the most prestigious institutions needed systematic verification procedures. The professionalization of finance accelerated after his collapse. Amateur methods and gentlemen's agreements were no longer sufficient. The Kreuger case also influenced international financial cooperation. Nations recognized that fraud could spread across borders instantly. Financial contagion required coordinated regulatory responses. The scandal prompted early discussions about international accounting standards. It demonstrated the need for compatible securities laws across countries. These conversations eventually led to modern international financial institutions. The International Monetary Fund and World Bank were influenced by these lessons. Global financial stability required cooperation and information sharing. No single nation could protect itself from international fraud alone. The Match King inadvertently helped create frameworks for global finance. His fraud exposed weaknesses in the international financial system. The responses to his collapse shaped institutions for generations. Even today, international financial regulations trace roots to 1930s reforms. The Kreuger scandal was a catalyst for systematic change. His name appears in footnotes of international financial law. For investors, the Kreuger story offers timeless warnings. Consistent returns in volatile markets should trigger skepticism. Complex corporate structures often hide problems rather than create value. Celebrity CEOs and prestigious backers don't guarantee honest accounting. Independent verification is essential no matter how trustworthy sources seem. Diversification protects against frauds that deceive even experts. If an investment opportunity seems too good to be true, investigate thoroughly. Don't assume that others have done adequate due diligence. Even sophisticated institutional investors can be fooled by skilled fraudsters. Madoff's victims included major banks and experienced hedge fund managers. Intelligence and experience don't make anyone immune to deception. Healthy skepticism and independent thinking are essential protections. The Kreuger principles apply whether investing thousands or millions. Verify, diversify, and maintain realistic expectations about returns. These simple rules could have saved investors billions in losses. The psychological aspects of Kreuger's fraud deserve examination. He exhibited classic traits of what we now call narcissistic personality. He needed constant admiration and validation from others. His self-image depended on being seen as uniquely successful. He could not tolerate failure or admit mistakes publicly. These psychological needs drove the fraud's escalation over time. Each deception became easier to justify internally. He likely convinced himself that he wasn't really stealing. The money would eventually be repaid when businesses became profitable. This rationalization allowed him to maintain self-image as honest businessman. Cognitive dissonance between actions and self-perception created internal stress. The suicide may have resulted from the collapse of his psychological defenses. When he could no longer maintain the illusion, existence became unbearable. Understanding these psychological dynamics helps explain how smart people commit fraud. It's not simple greed, but complex self-deception and ego protection. The media's role in the Kreuger scandal deserves critical analysis. Financial journalists largely failed to investigate his claims critically. They republished company press releases without independent verification. Interviews with Kreuger were deferential and unchallenging. Critical articles were rare and often dismissed as jealous attacks. The media contributed to the climate that enabled his fraud. This pattern repeats in modern financial scandals regularly. Business journalism often serves as marketing rather than investigation. Access to powerful CEOs depends on favorable coverage. Critical reporters find themselves excluded from important sources. This creates incentives for superficial rather than deep reporting. The Kreuger case demonstrated the need for genuinely independent financial journalism. Skeptical inquiry serves the public interest better than celebrity worship. Modern business media still struggles with these conflicting incentives. The watchdog role often conflicts with commercial interests. In the decades since Kreuger's death, his story has been revisited repeatedly. Books, documentaries, and academic studies continue examining his empire. Each generation finds new relevance in his rise and fall. The 1980s saw parallels with junk bond frauds and savings scandals. The 2000s connected his methods to Enron and WorldCom collapses. The 2008 financial crisis revived interest in his regulatory legacy. The Madoff scandal made explicit comparisons inevitable. Each era sees Kreuger through its own financial scandals. His story serves as a template for understanding fraud psychology. The details change, but the fundamental patterns remain constant. Ambition, deception, enabling institutions, and catastrophic collapse. This cycle repeats because human nature doesn't fundamentally change. Kreuger's fraud was distinctive in detail but typical in structure. Studying his case helps recognize warning signs in contemporary situations. History doesn't repeat exactly, but it certainly rhymes. The Match King's ultimate legacy is complex and contradictory. He built real businesses that survived his fraud and still operate today. Swedish Match remains a successful company under different ownership. His monopoly strategy proved viable when implemented honestly. The loans he provided did help stabilize some national economies temporarily. But these accomplishments are forever tainted by criminal fraud. Thousands of people lost savings they could never recover. Trust in financial institutions was damaged for generations. His suicide prevented any accountability or restitution process. Victims never heard explanations or apologies from him directly. The convenient timing of his death deepened the tragedy. Whether genius or sociopath, visionary or criminal, Kreuger contained contradictions. Perhaps that's why his story continues fascinating people. He represents both the promise and peril of modern capitalism. The line between innovation and fraud proved terrifyingly thin. As we look back across 9 decades, several conclusions emerge clearly. Financial fraud on massive scale requires institutional failure. One person alone cannot deceive millions without enablers. Banks, auditors, regulators, and media all failed in Kreuger's case. Systemic reform was necessary to address these collective failures. The regulations created in the 1930s substantially improved protections, but they haven't eliminated fraud, only changed its methods. Eternal vigilance remains the price of financial security. Each generation must learn to recognize deception in contemporary forms. The Kreuger principles transcend specific historical circumstances. Verify claims, maintain skepticism, diversify investments, and demand transparency. These simple rules protect against most fraudulent schemes. The Match King's suicide crashed Wall Street 90 years ago, but the lessons from his fraud remain urgently relevant today. Financial markets still reward trust while occasionally punishing it catastrophically. Understanding history helps us navigate these permanent tensions wisely.